Hello and welcome everyone to another episode of Refinitive's Perspectives Live. It seems now that we can't go a week without hearing the word crypto, NFT, or any other social scandal around digital assets. Outside of what we see in the press, what is the tangible information behind the social media noise? Traditional investors are beginning to look at digital assets for opportunities, but how can the digital asset market be priced with reliability? Joining me today to debunk some of the myths around digital assets is Kristen Mierzwa, Managing Director, ETP Strategy and Business Development at FTSE Russell, and also CEO of Digital Asset Research, Doug Schwenk. Welcome to the both of you.
Hello. Thanks for having us.
Thanks for joining and thanks for taking the time to discuss, one of the hottest topics, it seems, at the moment. Let's kick off with the first question that is obviously around the digital asset landscape. It has changed in the past 5 years. Maybe you can elaborate a little bit on the fact how it has changed in the last, let's say, 5 years, and what has brought on the adoption, especially from institutional investors. Maybe Doug can explain or give us a little intro on that.
Yeah, so 5 years ago, I think what we really heard a lot about was Bitcoin, and digital assets were Bitcoin. Even if there were others, we didn't really think too much about the others. They were all very early stage. They didn't offer a lot of use cases or tangible value that were easy to measure or to think about as an investor. 5 years later, we have a couple of big global events with a pandemic and excuse me, a lot of money printing by central governments and central banks, and we start to see the emergence of digital assets that have very strong use cases that are not Bitcoin and are much easier to understand. Things like Ethereum and Solana, and the rise of decentralized finance and digital assets and cryptocurrencies have come into the common lexicon, into our everyday lives with things like NFTs and crypto payments and things that start to enter our lives in ways that are meaningful and don't just have this sort of nebulous Bitcoin. What is it used for? Why would I want to have that? It has real practical value that institutional investors can understand and can grapple with.
Yeah, and maybe I could just add a little bit to that. I know now we hear like every news story is probably about ESG or digital, right? We all have the same newsletters coming into us, but I think we had a lot of headwinds for a long time in the digital asset space, and like what Doug was saying, everything turned around during COVID, and we had a lot of tailwinds. Some of those were, of course, the appreciation of some of the digital assets, but even during that time, the assets were volatile. But I think the other thing is people started thinking about what other tools are out there that I can add to my portfolio for yield, diversification, and it was hard not to kind of dig in and start doing the work and learn about the space. Maybe people had a bit more time during COVID to start listening to podcasts and get educated on it. It's hard to think about. We've all grown up knowing what fixed income and equity is, but then all of a sudden you had this new asset class, and you're like, what exactly is blockchain? How does that work? How do I invest in it? And it does take a little bit of time, and it's hard to do it in a few bullet points or to just quickly listen to one podcast. You kind of need to keep digging in and being exposed to it, and then it starts to click, and then people are like, okay, maybe I can add this to my portfolio in some way.
I mean, you mentioned the podcast and getting informed and having probably even a bit more time if we want to put it in that terms, but still the statement or what we hear also a lot of times is also that these digital assets are easy to buy, very accessible. People are explaining much more on those digital assets to probably also engage much more people that weren't engaged before, that just now are getting educated on all that and have the possibility. But as easy as they might be to buy, they're also probably very easy to lose. So how can clients safely own or manage these assets? Do you have any thoughts on that?
Yeah, maybe I'll start with that one. So custody is incredibly important when we're looking at the digital asset space, and it's come a long way. If tying it back to your first question about the last 5 years, and we have asset vetting that we do for any of the assets that are part of our eligible universe for indexes. And one of the main criteria that our clients are asking us about is custody. So we look through to the asset in the network and ensure that it has institutional quality custodians can custody on behalf of our clients or their clients. And we need to make sure that the wallets can be quite secure. So I think that has all come a long way. And if you even think about it, I think we think of our Coinbase or any of our digital asset custodians just like you would think of a Schwab or a TD, and the same functionality is there. It's all so easy right on your an app on your phone. Last weekend, I got even my dad to sign up for a Gemini account, and he's in his 70s. So I think we have come a long way where people are very comfortable because the front end tool looks and feels like those brokerage accounts that we're already used to. Doug, would you add anything more about the safety of digital assets?
Certainly very important because most of them are bearer instruments. So if you have the password or the key code, you have the asset or you can take the asset. And it has been really encouraging to see in the last 3 to 5 years the emergence of real institutional quality custodians that are taking assets of almost every type. And I think it's really necessary as an investor to make sure that the custody you choose is really of the highest quality.
And if we're now talking about the quality, safety, digital assets are used for criminal activity as well. How can these assets then be trusted? If we're now directly focused on safety, maybe Doug, to continue with your answer just now.
Yeah, so that's a really interesting point that a lot of people focus on. Digital assets were used by criminals in the early days pretty extensively. They are fungible and easy to pass around on the internet. What we forget about is that these digital assets have a transparent ledger, and it is easy for law enforcement to see where the assets go, to track. And once they know that an asset's been involved in a criminal activity, they can start to trace it to other criminal activity, and it actually becomes a breadcrumb trail for law enforcement. And the law enforcement that I have talked to find Bitcoin and other digital assets much easier to track than money through the banking system. To get criminal activity tracked that may have money going through the banking system, they have to get records from individual banks, and that can be a very time-consuming and difficult process, especially if those are international banks and it crosses borders. Whereas the Bitcoin ledger and ledger for most other digital assets is public and easy to see, and they get an opportunity to look at all of the transactions, and that's really been a boon for law enforcement. And we've seen that the amount of digital assets being used in criminal activity has dropped over time as a percentage. It continues to get smaller, and there are great firms like Chainalysis and Elliptic who offer services to help ensure that the crypto that you get is free from any association with criminal activity in the past or other bad actors. We do think that there are a lot of opportunities as well in crypto to be used for good. For example, you have this sort of tension between uh, assets that may be used for criminal purposes, but also create an opportunity for those who are unbanked, who may not have access to the same banking opportunities that we do because of the countries they reside in or the continents that they live on. Just don't have those sorts of services. We think about people in Venezuela or people in Africa who don't have the same opportunities we do in the sort of Western world, access to banking products. Well, crypto and digital assets can be available to those individuals and offer them opportunities to have yield, to transact with people that they don't know, and and it really does open up a lot of social opportunity at the same time. And I think that's something that when people are focused on the ease of use of this by individuals, they sometimes forget about the opportunity to help serve some of those individuals who don't have access to traditional products.
Would you even now, when we're talking about the point of data that is included, obviously, in the digital assets, would you even say that it might be more safe because we have more data to not even control, but to follow up on and to save and to collect, to make that kind of trading, more safe than money transactions that you were mentioning before?
Yeah, in some respects, it is safer and more transparent and gives us an opportunity to, yeah, collect on taxes, to know our counterparties better, to ensure that everything is being done in a fair and transparent way. Certainly gives a lot of opportunity for scrutiny that traditional banking and centralized counterparties don't offer.
Yeah. If we jump to another question regarding crypto a bit more, what are your thoughts on crypto being too volatile? How can clients access these assets, well, let's say without the drama?
Um,
Well, go ahead, Kristen.
Okay. Oh, I was just going to say it's funny because people always think of them as being volatile, and sure they are, but there's also plenty of securities that are in our standard portfolios that are quite volatile as well. So anytime you look at a single security or asset, it's going to behave probably more volatile than when you look at a basket. So I'll just give you a couple examples of what we observed in 2020. Bitcoin had 70% volatility, and a name that we all know and used quite a bit during the pandemic was Zoom. So Zoom actually had 85% volatility in that same year. So more than Bitcoin, but you don't think of Zoom as, a scary asset to invest in. So volatility doesn't always have to be bad. Another one was Novavax. So this was a biotech company that, of course, during the pandemic, anyone who was working on vaccines was probably going to have some positive volatility, and they did at 180%. So there's things out there that are volatile that are already in our portfolios, and I think, like Doug was mentioning before, we're kind of moving past Bitcoin only and thinking about the entire digital asset landscape. And if you get a basket of digital assets, you'll experience the same kind of thing that you'd experience in a small cap allocation or an emerging markets allocation. There'll be some volatility, but it can be smoothed by being in a basket.
There is one way to look at digital assets is really as a early stage technology investment. The technology is being developed to do a lot of interesting banking and finance and other kinds of use cases. And any early stage technology investment has volatility. And what we don't see is that in the traditional venture investment, that volatility doesn't get marked on a daily or minutely basis. Maybe once a quarter or maybe once a year, you understand whether your investment, the early stage company you've invested in, is going up or going down, and by how much, how dramatically. Whereas with crypto, we can see every second the price goes up or it goes down, and it creates a sense of drama that may not be any different than the drama that exists in other assets. It's just we can now measure it every tick on our screen, and it, in a smartphone world, it gives us more drama every second. But that, as Kristen said, that volatility is a very positive thing in an asset that's going up. You want to know that asset has the opportunity to go up. If you have that upside volatility, it will be accretive to your portfolio, and then the thing you want to make sure to do is rebalance that from time to time. Don't let that become an overwhelming amount of your asset allocation just on price appreciation. And then the most you have to lose is whatever maximum you've put on that as a percentage of your overall assets.
And since we're also talking about, or we talked about also the data that's playing a big role, what role do you think does data play in the modeling of a price of those digital assets?
So the data is really important if we want to understand what the real price of these assets are. We have to look through what can become a very noisy environment. These assets trade on lots of exchanges. We track over 450 of them. These exchanges pop up from day to day or time to time. They don't require a lot of regulatory licenses or infrastructure to start. And so what you don't know is, for a given price that you see on the internet, is that an accurate price or not an accurate price? And what we spend a lot of time on is vetting those exchanges for quality. Are they ensuring that the activity on their platform is real economic activity and not wash trading or data that's been manipulated, or even just immature data feeds that may provide you with only a piece of the puzzle. And so by really vetting those exchanges, by really looking carefully at the pricing data, we can come up with what is an accurate market price at any given moment. Part of the work we do with FTSE Russell is to produce those prices on a second by second basis, also hourly for end of day snaps. And those prices are derived from those exchanges with the highest quality, and ensuring that those are real economic transactions. And we see there can be quite a big deviation from that price and prices that come from those exchanges that may be less concerned about exactly what happens on their venue.
Yeah. And Doug, when we first started working together, you share what some of those price changes can be versus deriving prices from the exchanges that you vetted versus what you see out there. And I think those examples are really interesting to kind of share with everybody how big they can be, because they're numbers that we would never accept in the equity world. So maybe you could do a vetted Bitcoin price on our through our process, or what you might see out there on a free data aggregator, and then maybe a smaller or less traded asset would be interesting to talk about too.
Yeah, so we look at that every quarter, and it continues to be a pretty good delta during market events. And so when we look at last quarter, there were times, certain market events, where the price of Bitcoin was different by over 2%. And on average, I think it was 16 basis points difference. So we're seeing a persistent average difference, as well as a difference that can be pretty big when there's a sell-off or some other activity happens. Bitcoin is the most liquid, most widely traded, and so we would expect, and we do see that tends to be the tightest asset in terms of real price versus what's widely reported on some of the aggregators. Excuse me. When we look down the market cap to the 10th or 15th or 20th asset by market cap, we can quickly get to market events where the differences are over 30% and averages that are single digits in difference. And that's due to the fact that they are less liquid, less widely traded, and may be traded more often on exchanges that have price differences for legitimate or illegitimate reasons.
Yeah. Can you imagine our clients needing to, value a portfolio, and we've got one price and they've traded somewhere else, and, having a 2% to 30% difference in price? I mean, it's just, it would be unfathomable in the equity and fixed income markets, even, where it is a bit more difficult to figure out a price. So that's all the main work that FTSE Russell and DAR have been doing for years and years now, is trying to figure out about like how do we create a price that is of institutional quality and represents where the true market is and would be able to be used by our clients in both prices and if they're, you know, running a passive portfolio to our indexes. We want to make sure that they can track it. So that's been the utmost importance there.
Probably also as well as, you know, getting up to speed because of new assets that are coming into the market, and then being able to explain and to elaborate much more for the certain client base that you're having then, or anybody else, any other platform is having. I have another question on our side. So do you both obviously have any views of what the future of blockchain might hold for digital assets outside of cryptocurrencies? So if we do not focus too much on that, the future of blockchain and assets outside of cryptocurrencies, what do you think?
Well, there's a lot of cases that would be outside of cryptocurrencies that are part of the crypto landscape today. If we think about NFTs, for example, being used for things like artwork or your tickets to a sporting event or to a cultural venue, something that is unique and non-fungible, that's not tradable with someone else, but does give you a unique representation of some real world item or something in the metaverse. All of these are built on blockchain technology. I think one of the things that we've seen over the last 3 to 5 years is that the use of blockchain really does work better in these kind of public blockchain assets. And so we may think about them as being cryptocurrencies, but we may also think about them as enabling other uses of the blockchain, being the fees that we might pay to transact with an NFT, or to buy or to sell an NFT, or the platform that allows for these NFTs to exist. We heard a lot 5 years ago about blockchain that was permissioned and private, and it was the mantra was sometimes blockchain but not Bitcoin. And I think what we saw was that didn't really work as well. The amount of investment required to build your own private blockchain and to create an ecosystem around that was just too expensive. But by using these public blockchains and riding on top of them for other types of uses, we can see a lot of interesting applications that take advantage of this infrastructure that exists for things like the Ethereum blockchain, for example.
Yeah, and I think if I've learned anything over the last couple of years looking at this space is that creative people are leading the way. So, you know, and we're in finance, so you know, we think about the practical use cases, right? We all know that the payment rails are inefficient and that blockchain is going to help with that. Nobody likes waiting for 2 days for settlement, or how hard is it for us to transfer cross-border, you know, even $5,000 to your own account in a different country takes forever and it's quite hard. So I think that use case is really easy for us to understand. But I think that the gaming community and these creators are going to push the limits of these assets more than we would ever even think about. So that's exciting to see how that comes about. But then I start hearing things about people talking about extracting yield from the supply chain in a way that we could never do before. So even with manufacturing, like any part of the supply chain you can put on blockchain. I could step in and finance different parts of the supply chain in a way that I couldn't before, and then extract yield that way. So I think that's going to be a really interesting opportunity when you come back to the finance world and figuring out how do I put that in my portfolio. So I think there'll be a lot of that. And then the whole concept of Web 3.0, you know, you have to do the whole story of 1.0, 2.0, and 3.0. But I think we all understand that a lot of Web 2.0 is the social networks, and that's centralized around certain companies who control other people's data. I think we're going to see that change where people will own their own data, and that will be because of the blockchain. And you'll get to decide, you know, who has access to that and not. And I think that that's going to be really interesting to see how that changes the way we all live.
You mentioned also the creative people, other participants of that market being included. I'm thinking now of Tarantino's uncut scene content that himself is selling as an NFT, things like that, I believe it makes even more people being interested in that market and then being, involved to it, educate themselves, and then become new participants, obviously. So do you see a focus on that a little, or do you think it will be balanced in the let's say in the future, obviously in the next years, midterm?
Well, I think it's great because it made people understand it, kind of like the NFTs are like digital baseball cards, right? But then when you bring it back to our world in finance, that's a collectible, and it's always been quite hard for us to put a daily value around that because it's subjective, or of value to a smaller group of people. So I'm glad that I felt like one of the headwinds that we were facing for a long time is what is this? What is this? But when there was a Saturday Night Live sketch on NFTs, I'm like, okay, we're there now. This is every day. And I think, it's not going away, and everyone's just going to start to understand it and integrate it into their lives.
Perfect. Thank you so much for your insights, and thanks for joining this episode. I will will come back to you for another second episode, maybe a bit more detailed or focused. So I would be happy to have you again on board. Thanks for taking the time, and thanks for sharing.
Thank you.
Thank you.
Thanks. If you enjoyed today's episode, you can learn more about the FTSE Russell's digital asset and data indexes by following the link below, or if you click on the comments below. I'm Shahad Makiza, and you can join us tomorrow for a conversation on improving the advisory experience in 2022 and beyond. Happy to have you there.